Hi everyone, welcome back to the Attract Capital webinar series. I'm your host Sarah and I'm here with Attract Capital CEO Dave Barnett.
Hi everybody.
So today we're going to talk about the value of back-ended growth debt structures. And so starting off, Dave, can you tell us what a back-ended growth debt structure is in the context of middle market financing?
Very good question, Sarah. So a back-ended growth debt structure is a loan that is back-ended, where the principal is repaid, usually in the fourth or the fifth year. It could be partially back-ended, but more than likely it'll be fully back-ended. It's usually a 4 or 5 year term. And it could be, there's several different types of loans that it could be. It could be a simple term loan, it could be a mezzanine loan, or it can be an equipment loan.
Okay, so can you tell us a little bit more about what these are used for?
Sure. So back-ended growth debt structures are used for long-term growth initiatives where it requires a large upfront inflow of capital in order to get the investment going. It can be strategic growth, as a lot of our clients are involved in. This is a new product launch. It could be a new
service, something like that.
New market expansion, or it even can be an acquisition.
Okay.
And the reason the back-ended is valuable for these types of investments is that it mitigates the uncertain cash flow production from the investment, which means that you're doing something new and you really don't know how much cash is going to come back to you in what time period. So it's good not to have to worry about paying the debt back until the very end.
It gives you a little bit more room.
Well said, Sarah. Very well said.
So can you tell us some ways you've seen these really propel growth in the middle market companies that you work with?
Sure. I mean, really what it is, and we just touched on it, it's sort of a virtuous cycle of when you make an acquisition, you have a back-ended growth debt structure. If you can take the cash that you're generating, you can reinvest it in the business, and you can continue to grow the business organically. So you have two engines of growth. You have acquisition growth, and you have organic growth. So that's one of the ways that it propels. You essentially get faster growth. It also is an insurance buffer against any downturn that you might have or any unexpected event. So
like a pandemic.
Right, exactly, like a pandemic.
That.
So you have something bad where you need more money to get back on track again. And just at a very high conceptual level, if you're pursuing integrative growth, integrative to your customers or to your operating model or to your product line, it allows you to capture the synergies from that integrative growth. So there's a lot of positive benefits that can really propel your middle market company.
Okay, so I mean, if people at home are interested in accessing these types of growth debt structures, how are some of the ways they could do that?
So a tip first, determine how much cash or capital you really need to pursue your growth. Then design your capital budget around this plan. And then really dive into all the different options there are, because as I mentioned earlier, there's mezzanine debt, there's a term loan, there's equipment debt, but there's at least 3 or 4 different types of varieties of those loans that are out there. So the more you learn, the better decision you'll make, and you can always call us at Attract Capital.
I was going to say, I'm sure that they can come to you for more information on that.
Absolutely.
So I think they have it. Yeah. Thank you guys so much for joining, and we will see you at the next webinar.
Thanks.